No one could imagine that at this point in history, banks would be facing their toughest challenge in well over a decade, with over $1 trillion in unrealized losses haunting the economy like the ghost of a 40-year-old male virgin. Analysts have reported that banks are currently headed on a collision course with their own balance sheets. A seemingly unlikely situation has come to the forefront at exponential speed over recent weeks, with a chain of American banks falling apart and contagion even spreading quickly across the Atlantic to Switzerland. And this is just the beginning. One of the oldest and biggest banks in the world, Credit Suisse, has now fallen victim to this collapse. The media continues to push the narrative that the Fed came to the rescue to save the day, that the world's financial system is otherwise healthy, and these instances are the result of only a momentary glitch in the economy. Nothing to see here, people. Keep moving. But are things as safe as we're told? Is the economy really as robust as a men's fitness cover model? The reality paints a very different picture. A brand new report has been released from professional economists at the Social Science Research Network that clearly identifies 186 more American banks vulnerable to the same risks that brought down our recent victims. That's right, 186 American banks are currently on target to face imminent crisis. That's astonishing. How could this not be more well known? Should this information really be kept secret from the conscientious public? And if things really do fall apart, can you even imagine the number of bank runs that would occur? For any of you who live under your bed with your head in a suitcase, recent news has been rife with tales of woe in the banking system. Banks have been falling apart all over the place, starting predominantly in California, United States. The largest bank to collapse was Silicon Valley Bank. Many now see this entity as something of a criminal organization. This is because they refused to follow standard banking regulations and were more observant of social equity and diversity policies than the financial stability of their businesses. We can also still see this problem largely reflected across the industry today. Regardless of diversity initiatives, what really caused the bank to collapse was the loss of billions of dollars as bond prices dropped, and every single American bank in existence also lost money on the bonds they owned too. A few days after Silicon Valley Bank collapsed, Signature Bank followed their lead, shortly followed by First Republic Bank, who had been on their way to the ground for well over a week. Banks were relying on the value of the assets they hold, but when asset prices fell, the banks lost trillions of dollars worth of value. For many US bankers, the news was too shocking to process. This may seem like an oversimplification of recent events, but in a nutshell, that's what happened. What many people don't realize is that far more banks have lost value in their capital than initially realized. The extent of how many other banks were affected was only brought to light by the recent release of an academic paper a few days ago that exposes just how bad things really are. This paper has a name that is pretty easy to miss. It's called Monetary Tightening in U.S. Bank Fragility in 2023, Mark-to-Market Losses and Uninsured Depositor Runs. But don't be put off by the hefty title. Essentially, this paper carried out an analysis of U.S. banks and their asset exposure. We analyze U.S. banks' asset exposure with a recent rise in interest rates with implications for financial stability. The U.S. banking system's market value of assets is $2 trillion lower than suggested by their book value of assets accounting for loan portfolios held to maturity. What this means in plain English is that $2 trillion worth of losses are not being ignored due to sneaky accounting rules designed to help banks maximize profits and pull in billions of dollars. But don't stop there, it gets much worse. We all know how the economy is like a house of cards, right? Or maybe a better analogy would be a chain of dominoes. If one chip falls, the whole system is liable to follow suit, one piece at a time. Well, think about it. When Silicon Valley Bank collapsed, they had to sell all the assets they held. As a result, the average value of those assets fell across the entire global market by roughly 0.4%. This is staggering. 0.4% may not seem like much to you, but honestly, the ramifications for the global economy are huge. This makes the entire system just that much more fragile. A bit like when you spill milk on your pants at school and risk having all the other kids laugh at you every time you stand up. But just imagine the following scenarios playing out next. The first may seem unlikely. This is the most extreme bank run imaginable, taking place imminently, where banks are forced to liquidate 100% of their assets in a short space of time in order to pay out every single depositor at once. If this ever occurred, the report outlines that 2,315 American banks would become insolvent and be unable to pay back depositors' money. Can you imagine going to the bank to withdraw the money in your current account or savers account, only to be told that the bank no longer has your money? Your money has simply gone. This scenario is extreme and relatively unlikely. About as unlikely as bumping into the Olsen twins and having them invite you back to their place for a late-night rendezvous. Indeed, comfort can be taken in the fact that the first £250,000 in every account is supposed to be guaranteed by the government. This makes the occurrence of a bank run underneath that mark very unlikely. So if that scenario is unrealistic, what is more possible? As outlined in the paper mentioned earlier, a second scenario could be that all uninsured FDIC deposits are suddenly withdrawn by banks' depositors. According to the report, the result would be that 1,619 American banks alone would go insolvent. This is much more possible, like logging into your favorite adult website and stumbling across a video of your ex. Any cent or penny of bank depositors' money over the $250,000 mark is legally uninsured. That makes it likely that depositors with half a brain would want to withdraw anything over $250K. But for all those skeptics out there who still believe this is too unlikely a situation, or maybe you just don't think the average banking customer is aware of the $250K insurance limit, what about if just 50% of uninsured deposits are withdrawn? This does not even have to happen that suddenly. It could be over a more prolonged period of time. Many expert analysts have predicted that this is a very likely situation in the near future. To put that into perspective, Silicon Valley Bank saw around 25% of their deposits withdrawn in the course of a single day. So just imagine what would happen if 50% of deposits were withdrawn from other banks over a slightly longer time frame. This is so realistic, some economists have concluded it is inevitable, like the possibility that Logan Paul is a fraudster, or at best, a massive loser in real life. Under these kind of circumstances, the report lays out that 186 American banks would find themselves insolvent. That's right, if 50% of deposits of the amount over $250K were withdrawn over a prolonged period of time, 186 American banks could fail. Can you imagine what this would do to the global economy? The turmoil over the last few weeks was caused by a total of 5 banks collapsing. What about if 186 banks collapsed? And again, to make matters worse, each collapse sets off a snowball chain of further calamitous ramifications for the markets. Every time a bank collapses, it is forced to sell its assets to pay its depositors, just as Silicon Valley Bank had to. These massive sell orders are known as fire sales in global markets, and they always result in the value of assets to drop even further. This means that for all remaining banks who have so far survived the turmoil, any exposure to these assets they have may, in turn, puts them too at risk of a collapse themselves. That's right, if every American bank liquidates only half of their uninsured customers' deposits, it is hard not to envisage the entire US financial system collapsing, which of course could pull down the entire global system with it. In fact, if the asset discount was 0.4% following the Silicon Valley Bank collapse, the report states that projecting this percentage to this scenario would lead to a further 1,724 banks collapsing. It never ends. So, 1,724 banks will likely go insolvent if their customers don't touch a single cent or penny of their insured money and only choose to take out half of their deposits that are uninsured. This is ludicrous. Seriously, can you even imagine what would happen next? Imagine the impact this would have on your everyday lives. This is what the expert economists have paid out as possible future reality. Just how accurate they really are, we may be about to find out very shortly. You've unlikely heard about this report discussed in the mainstream media. The Wall Street Journal did mention the report, but they glossed over all the key points and actually painted a very positive impact of what might happen. It's almost like the average member of the public is not supposed to be aware of the real risks to the global economy. In a way, it makes sense, as this knowledge would motivate more people to take money out of their bank accounts, which would only spur on the chances of a bank run. Here is a direct quote from the final notes of the economists in this report. Even if only half of uninsured depositors decide to withdraw, almost 190 banks are at a potential risk of impairment to insured depositors, with potentially $300 billion of uninsured deposits at risk. If uninsured deposit withdrawals cause even small fire sales, substantially more banks are at risk. Overall, these calculations suggest that recent declines in bank asset values very significantly increase the fragility of the US banking system to uninsured depositor runs. To add to that, a coalition of American banks known as the MBCA or Midsized Bank Coalition of America are also saying the same thing. The group sent a letter to the FDIC imploring them to insure 100% of their deposits for the next 2 years. 100%! This coalition is made up of 110 American banks. Some of these banks even have assets valued at $100 billion. Imagine that this entire group lacks confidence in their financial security and is looking for formal strategies to avoid a catastrophic bank run. But what exactly did the coalition say? Notwithstanding the overall health and safety of the banking industry, confidence has been eroded in all but the largest banks. Confidence in our banking system as a whole must be immediately restored. It is imperative we restore confidence among depositors before another bank fails, avoiding panic and a further crisis. What do you think about this? To me, it sounds like 110 American banks are aware of a pending disaster and looking for ways to offset the risk. It sounds like they are looking for a bailout from the FDIC, which is exactly what happened to Silicon Valley Bank. But what happens if FDIC declines? In the words of one former banker, former member of the House of Financial Services Committee and current US Congressman, if you don't do this, there's going to be a run on your smaller banks. Everyone's going to take their money out and run to the JP Morgans and these two big-to-fail banks, and they're going to get bigger and everyone else is going to get smaller and weaker, and it's going to be really bad for our system. As we all know, more concentrated power in the hands of the elites is never a good thing. There is clearly no easy solution to this mess. Banks have always been allowed to invest the money you hold in your accounts instead of holding it as physical cash or gold, which means that all banks are currently at risk of finding themselves under-collateralized when the price of all assets is falling rapidly. Everyone knows that banks have lost billions of dollars in bonds over the last several years. Can you imagine if everyone in America went to withdraw their money tomorrow? The entire banking system would simply collapse like a table piled with fat guys. How on earth do you think we could get out of this mess or simply just protect ourselves and our personal wealth? If you have any ideas, make sure you share them in the comment section below. Finally, don't forget to like this video and subscribe to our channel, the fastest growing and most popular finance and investing channel on the internet today.